Hello everyone, I'm Nova Lui, RHB Bank's Head of Investors Advisory. Welcome to our Quarter 4 Fund Discoveries podcast series. Before we look into the potential funds for consideration in Quarter 4 this year, let's review the industry fund flow. Quarter 3 2022 is the first time we have observed inflow in money market funds topping the list of fund inflow to the market. This is potentially due to continuous pressure from US Fed to hike interest rate, which will put pressure on the equity market. Investors stay on sideline by temporarily positioning in lower risk funds to be redeployed when the market sentiment turns better. There are also investors who invest into USD-based money market fund to ride on the higher interest rate in US and the potential appreciation of US dollar. Beside money market, we have also observed that investors protecting their portfolio by shifting into global bond fund. Within the equity fund space, global equity, technology, and China remains the top favorite for investors who continue to be positive in these areas. While for the outflow fund in Quarter 3 2022, investors are raising cash from areas where there are no losses or minimal losses. This mainly come from the emerging market asset such as Malaysia or Asia Pacific bond fund. Besides bond fund, investors also raise cash from mixed asset funds. Let's kickstart our fund discoveries with the global equity fund that is RHB US Value Fund. Most investors who has exposure in global equity fund may likely to be exposed to growth sector due to the US market itself, which has high exposure in technology sector. RHB US Value Fund offers diversification opportunity for investors to balance up one's portfolio by adding exposure into value underlying to your portfolio. Volatility and slower economic growth in US warrant necessity to look into value and defensive investing style. US value stocks are supported by elevated inflation, rate hike cycle, tighter financial conditions, and undemanding relative valuation. The banks are expected to gain from an aggressive Fed through the increase of net interest income in the quarters to come. The fund focuses on US large caps that have the capability to conduct share buybacks with their retained earnings. The fund provides diversification into cyclical non-tech exposure while leveraging on JP Morgan asset management expertise in stock selection. Next, within the developed market equity space, there are investors who are seeking funds with higher beta or, to put in layman term, higher risk product, high risk, high return. For such investor, may consider RHB Global Artificial Intelligence Fund. As of year to date, both US S&P 500 and Nasdaq markets have suffered double-digit losses. However, despite inflation fear and rising interest rate pressure, US labor market remains robust, defying expectation of a hard landing. RHB Global Artificial Intelligence provide long-term capital growth by investing in the global equity market of companies whose business will benefit from or is currently related to the evolution of artificial intelligence. By now, market has potentially priced in most of the interest rate hike fear until mid of 2023. While if there is any reversal in the rate hike cycle or improvement in market sentiment, such high beta fund potentially benefit from the market recovery. Prior to 2022, the fund has 3 consecutive positive return years, with year 2020 recording more than 90% return in a single year. However, as of end of September, this fund is down by almost 40%. Investor who has a long-term investment horizon and wish to take tactical allocation view into sectoral fund may consider RHB Global Artificial Intelligence to be inclusive in your portfolio. However, please take note that total exposure of all technology-related funds in your portfolio as single sector funds tend to be more volatile despite investing into a developed market. Moving into emerging market space, due to market volatility, investors may consider a more diversified fund. TA Asia Absolute Return Fund is a fund that may benefit investors in such volatile market. The fund fell near 23% as of 30th September 2022 opening up opportunities to new and existing investors to add more exposure at a cheaper NAV price. Chinese technology sector valuation and share price are deemed attractive after beaten down by regulatory crackdown, external headwinds, and zero-tolerance COVID-19 policy in China. MSCI Asia ex-Japan is among the cheapest broad-based index on both price-to-earning ratio and price-to-book ratio. Economic reopening and border reopening theme are in play as Asian countries has not fully reopened to the general public of the world, especially in China and Hong Kong. Pent-up demand, revenge spending are potential market movers in the quarters to come. The fund's external investment manager is Fullerton Investment Management Singapore. The fund managers aim to achieve positive return in any business cycle on a 3-year rolling period. The fund adopts an absolute return benchmark of 8% per annum. Cash and index hedges are employed opportunistically to preserve capital and capture opportunities during period of market downturn. The fund actively reallocate its position on bottom-up basis, seeking for opportunity to buy low in order to achieve the fund's long-term investment objective. As of end of August, the fund's main exposure is in Hong Kong, Singapore, and Taiwan. At the same time, the fund was holding 15.7% cash to be redeployed into the equity market. Within the emerging market space, we also like Indian equity as a potential diversification in investors' portfolio. Manulife India Equity Fund offers opportunity for clients who seek for a different allocation within the emerging market space. India has the highest factory activity by S&P Global Survey among the large economy, underpinning economic resiliency. Manufacturing plants of large foreign companies in China are beginning to diversify out of the country. Apple iPhone 14 is a good example. India's headline inflation is among the lowest relative to the large economy at 7.41% as of September 2022. India's policy tightening cycle will benefit the banking sector through high collection of loan interest income, which would be accounted for in the quarterly earnings to come. As of August 2022, the fund has more than 30% exposure into financial sector. According to IMF latest country growth outlook, India is expected to be the fastest growing country among major economies at 6.8% in 2022 and 6.1% in 2023. For investors who are relatively conservative or to be exact, a moderate investor may consider our RHB ESG Multi-Asset Fund. This is a new fund which was just launched on 3rd October 2022. The fund fits into BlackRock Global ESG Multi-Asset Fund. As of January 2022, BlackRock manages $10 trillion USD of asset under management, which is the world's largest asset manager. The fund is a qualified SRI fund investing into a target fund which adopts principles of ESG-focused investing. This includes screening, selection, monitoring, and realization of target funds investment by management company. Target fund managers aim to invest into resilient, profitable company with persistent pricing power based in developed market. The fund positions itself in various asset classes such as fixed income, derivative, futures, exchange-traded funds, and cash with aim to reduce portfolio volatility and to generate consistent and stable price movement. The target fund is one of the biggest global ESG multi-asset funds in the market. According to Morningstar, the target fund is ranked in the top quartile in various investment periods. As of end of August 2022, the target fund's 3-year annualized return is 6.42%. Finally, for investors who are seeking for investment into income fund with some exposure in foreign market may consider RHB China Bond Fund. This is also another fund on our platform that fits into BlackRock funds. RHB China Bond Fund is a well-diversified cross-multiple bond paper in various sectors that reduce the potential loss in case of an event of default. As of end August 2022, the fund has repositioned into financial-related sector bonds, while the rest are mostly into government-related bonds. China is widely expected to loosen its monetary policy to accommodate the country's agenda to bring back the country into expansionary mode. China fiscal policy is also expected to be supportive to boost infrastructure projects and to support families and businesses to recover from the COVID-19 zero-tolerance disruptions. The eventual exit of COVID-19 zero-tolerance and economic reopening would fuel positive sentiment in the financial market. Yield to maturity on the China investment grade bonds are relatively better than the developed market investment grade bonds. The fund has a good distribution track record. Thank you for listening for our fund discoveries idea. Please engage our relationship managers if you wish to know more of other funds on our platform. While visit RHB Merge website to view our other money chat or podcast series. Thank you for listening.